Hello, and welcome to our third video going through all the summaries of all the content in Unit 3 and 4 VCE Economics. Today we're going to be looking at Unit 3, Area Study 3, Australia and the international or the world economy, everyone's favourite area of study, which is always going to come up on the exam and is usually done pretty poorly on. Actually a pretty short area study. It's not even worth that much in terms of your study score. It's only 25% of Unit 3, but it is very, very important. And it's actually not as difficult as it looks. Hopefully, as we're getting very close to the exam, it's just 2 weeks and 1 day away. You have hopefully been doing a lot of examination papers to keep yourself busy, and therefore you're hopefully nailing all the content right now. But we're going to go through all the key knowledge one by one and a couple of practice questions along the way. So our first key knowledge dot point is the relationship between trade and living standards, which include things such as lower prices for consumers, greater choice for consumers, the ability to achieve economies of scale, access to more resources for business and government. So trade means that consumers have access to cheaper goods and services from overseas, as well as more choice. So that's good for our material and non-material living standards. So access, great for material. Choice, great for non-material. So it improves non-material and material living standards. Trade also means that businesses have access to a larger market, which helps to achieve economies of scale production. What that means is that your fixed costs become a smaller proportion of your overall costs. So for example, if you own a factory, you have to pay rent for that factory every month regardless of how much you produce. So let's say, for example, rent is $100 and you produce 100 things. You're basically paying $1 in rent per thing that you produce. Then when we open up to wider economies or more economies, you can now produce far more than 100 things, but you're still only paying $100 rent. So that rent becomes a smaller proportion of your overall costs because of economies of scale. It means that businesses can become more profitable. Trade also means that businesses and governments have access to cheaper or higher quality resources from overseas, which can help to improve our productivity. So for example, it means that we can get high quality, for example, white goods and technology and automotive vehicles from other countries because we're not good at making them. So by getting them from overseas, it means we can focus on areas of comparative cost advantage or comparative advantage and therefore perform better as a country. Next up, we've got the balance of payments and its components. So the balance of payments is a record of financial and investment transactions coming into and out of Australia during a year. And when we refer to into and out of, that is what we're referring to as credits and debit transactions. So into Australia is always going to be a credit, money coming in, and out is going to be a debit, is money going out. So in that, it's broken down to the current account, which is basically transactions which occur in that calendar year, usually from things like imports, exports, and incomes, and the capital and financial accounts, which occur on the other side. These two things balance each other out. This is a bit more detail than you need right now in the current study design. We've got the current account on one side, and then on the other side, we have the capital account and the financial account. And these two things together, when you add them together, equal 0. So for example, if the current account is in surplus and it is positive 10, the capital and financial accounts together need to equal negative 10 because they zero out. Because often transactions in one will have an opposite transaction in the other, and we'll get into those as we're going through. So the current account comprises of 4 main sub-accounts. The first one being net goods, second being net services. They go together pretty well. These are goods and services exports minus goods and services imports. Exports are credits, imports are debits. For example, if we have a foreign student studying in university in Australia, that is a services export because we are exporting the service of education. That is a credit coming in. If we sell iron ore to overseas, that's an export credit. That is money coming in. Whereas if you go on a holiday to America, that is a services debit because that money is leaving Australia. Next up, the biggest account that we have is net primary incomes. This includes credits and debits of salaries, interest repayments. I'm going to highlight interest repayments because they are incredibly important on foreign debt, and dividends. Now, net primary incomes is one of the largest reasons why we often have a current account deficit, because this is where the interest on our foreign debt is paid. And we have over $1 trillion of foreign debt. So when interest rates rise, or when our foreign debt grows, we now have more interest repayments on this foreign debt, and then that becomes a massive debit coming out of our current account. It's the largest component of our current account. and the main reason why historically we've had current account deficits. Then we've got net secondary incomes, which are one-way transactions with no expectation in return, such as foreign aid. This is only debits really in here. It's going to be negative. Sometimes you've got to add these things together in multiple choice and say whether we're in a current account surplus or deficit. You'll find that in questions about the current account now, it refers to the current account balance. If you know that we're in a deficit or a surplus, use that in your answer. It shows great understanding. So to apply this to an exam question, we have from 2021, we've got, with reference to the graph above, explain the trend in the current account balance over the last 2 years. So we've got a trend here. So one thing VCA loves to do is give you a lot of extraneous data. We need the last 2 years, which is going to be from here, and we just cross everything else out because VCA is just trying to distract you. So we only care about from here, and current account is our dotted line to here. When we're explaining the trend, what we need to do is say where we started, where we finished, and what direction we are going in. And with explaining the trend, we'd probably want to give some detail about what that is occurring. So here would say that we are around 1.5% in 2019. So we are in a surplus of 1.5% of GDP in 2019. And since then, the current account surplus has increased to over 3% in 2021. And if we want to suggest why that is, well, that could be because of the trade surplus that is occurring based on that other line. Next, we have the capital account. The capital account mainly deals with the transfer of funds into and out of Australia due to migration. So this is mainly migrants coming into Australia and bringing their assets with them, being a credit, or people migrating out of Australia and taking all of their wealth with them and therefore being a debit. This is most often in surplus because we often have more migrants coming into Australia. Skilled migration is one of our greatest tools for our aggregate supply. And therefore, this account is almost always in surplus, except for a brief period during COVID where we had more people migrating out of Australia. Then we've got the financial account, which is mainly about investment and has a few sub-accounts. You don't technically need to know these sub-accounts. They're not listed in the study design, but they're great to show strong understanding of what happens in the financial account. So we've got net direct investment, which is investing in land or businesses in Australia or overseas. If an overseas company is investing in Australia, that's a credit. If Australians investing overseas, that is a debit because in the short term, the money is leaving the country. We've got net portfolio investment, which is the same thing but on a smaller scale, often investing in shares, bonds, things of a non-tangible nature. So for example, if you go and buy shares in Tesla, there's going to be a debit out of Australia because that is a foreign company that is going to be getting that money in the short term. The important thing about the financial account is these transactions will often then have an opposite impact on the current account. So for example, if an American business, let's say Taco Bell, invests in Australia, they open up franchises in Australia, that's a credit in the financial account. However, when they make a profit, that profit is going to be sent overseas, which becomes a credit and a debit in the net primary income sub-account of the current account. Then when we get with our current account, we have causes of a current account deficit or cyclical and structural factors that impact our current account balance. So with cyclical factors, it's about how changing levels of economic activity impact the current account. So, and this kind of works counterintuitively to what you'd think. So it's really important to know the process here. So when an expansion continues occurring, so economic activity is rising, unemployment falls and incomes rise. As incomes rise, more spending spills over onto imports, which increases debits to the current account. And therefore, this either increases the cyclical current account deficit or decreases the cyclical current account surplus. So when we're in an expansion on the business cycle, so when we're in the business cycle and we're on a rise, so we're going up, that is going to lead to more spending spilling over into imports because of higher average incomes. And that leads to more debits in the current account and possibly a cyclical current account deficit. The opposite's also true. If we're in a contraction, people save rather than spend, there's less spending on imports, therefore there's less debits from the current account, and therefore we're more likely to move towards a cyclical current account surplus. Then we've got structural factors. These are long-term, usually aggregate supply-based reasons why Australia's current account has historically been in deficit. There's two main ones here. There's one that I mainly say to use now, but there's two, and we'll go through them in opposite order of what I recommend. So firstly, Australia, compared to the rest of the world, is a relatively young country, and we require constant investment to grow our economy and make use of our natural resources because we're rich with natural resources, but pretty rubbish in terms of labour productivity and technology. So we need to get investment from overseas to increase our capacity. We don't have a lot of savings to pull from to invest in our country. The average household in Australia is in debt 182% of their income. So there's no money to pull from, so we've got to get it from somewhere. So this savings investment imbalance must then be filled by foreign funds. That increases our net foreign debt. So that increases foreign debt, and then also then increases debits in net primary incomes. And therefore that leads to a structural current account deficit. What I recommend you use now, because it's a lot simpler to describe, is our low level of international competitiveness. So due to our low efficiency and our high costs, so our really high minimum wage, we struggle to compete in international markets. Therefore, our exports are less competitive, which leads to lower exports overall, which is going to mean less credits relative to debits. In net goods and net services. And therefore, that is going to lead to a current account deficit or a reduced current account balance. And therefore, that's how that's going to occur. So low levels of international competitiveness work really, really well. So if we had to explain how one structural factor might result in an improvement in the current account balance, we could talk about an improvement in international competitiveness. So if we had one structural factor could be an increase in our international competitiveness. So for example, if technological advancements led to increases in productivity, that'd mean that there'd be downward pressure on prices. And that our exports would become more price competitive, which would then lead to an increase in credits in net goods and net services. And therefore, that would lead to an improvement in the structural current account. And then that would get you the marks for that. The thing that threw students on this question was that improvement. They're not used to that. So be wary that you could need to go either way. So like I said a little bit before, you need to know about the relationship between the current account and the capital and financial account. A lot of the time, this comes up in questions about how a transaction would impact both. So usually any transaction which impacts the capital or financial account has a corresponding transaction which occurs in the current account. So for example, if Australia receives credits for investing in a business by net direct investment in the financial account, this would mean that debits would be created in net primary incomes as some of that business's profits are sent overseas. So if we have a business invest in Australia, that's a credit. However, when the profits are sent back overseas to that business or the owners of that business, that is a debit going out in the current account. Next up, we've got the composition and cause of net foreign debt and net foreign equities. These you really just need to know what they are. A really important part is that they aren't just what we owe. So net foreign debt is the balance of all the funds that Australia has borrowed from overseas against what overseas countries have borrowed from Australia. And this includes both public and private debt. So really important here, it's not just what we owe, it's what we owe against what people owe us. People might not owe us much, but without that part of the definition, you cannot access full marks. Net foreign equities, the exact same thing, but it's about asset ownership. So how many assets are owned by overseas people in Australia versus how many assets are owned in other countries by Australians. Then one of the most complex parts that people hate of this topic is the terms of trade. Terms of trade is not as hard as it looks. Terms of trade is a ratio of average prices received for exports divided by or compared to or relative to average prices paid for imports. The most important thing with the terms of trade is that quantities remain the same. Quantity doesn't change, it's just the price that has changed. The demand remains consistent. So when export prices rise, we are still selling the same amount of exports, and so that is favorable. So whenever the prices change with the terms of trade, quantity remains constant. So therefore, if export prices increase on average and or import prices decrease on average, it's a favorable aggregate demand side factor because it means more injections coming in or less leakage is going out. And so factors that might influence the terms of trade are things like the exchange rate. So if there's an appreciation of the exchange rate, exports are worth more, imports are worth less, therefore terms of trade improves favorably. Economic activity of our trading partners. So for example, if there's a high demand from China for our iron ore, that drives up export prices and therefore terms of trade increases favorably. So what this means is when there are increases in the terms of trade, it means that there are more export credits or less import debits in the balance of trade, which therefore impacts the current account. It also means increased aggregate demand, which leads to increased economic growth as it sends a signal to producers to increase production. That will also increase the derived demand for labour and decrease unemployment. However, it may mean we run into shortages, which will put upward pressure on prices and therefore cause demand inflation. It can also increase material living standards as average incomes are likely to rise due to increased or decreased unemployment. And if import prices have fallen on average, this could lead to increased choice and satisfaction for households as they have more purchasing power as imports are cheaper and they can buy more goods and services from overseas. Our next key knowledge dot point is the exchange rate, and the exchange rate is just the value of our currency compared to another, most often the US dollar, but it could be against any other currency. Anything that increases the demand for Australian dollars on the foreign exchange market will lead to an exchange rate appreciation. This could also be anything that decreases the supply, as they mean basically the same thing. And then on the opposite side, anything that decreases the demand for the Australian dollar on the foreign exchange market will lead to a depreciation or increases the supply. So it's really important to know. So think about when you've got exchange rate questions, think about where is the money going? Are people going to want Australian dollars or are they going to want another currency? And that will help you work out if it appreciates or depreciates. So if the exchange rate appreciates, this means there will be less demand for our exports and more demand for imports, which reduces the balance of trade and means we're less likely to have a current account surplus. So if the exchange rate appreciates, our exports become less price competitive, therefore there's less demand for them, and we're more likely to import relatively cheaper imports. An appreciated exchange rate does, however, mean we're more able to repay our foreign debt, as one Australian dollar is now worth more, and also it can be favourable for aggregate supply, as it can decrease cost of production for businesses who use imports as factors of production. Then, getting to our final point about our international competitiveness, so factors that impact our international competitiveness boils down to productivity, production costs or cost of production, availability of natural resources, exchange rates, relative rates of inflation, and the effect these have on macroeconomic goals and living standards. So the main thing here is that high wages in Australia and low productivity tends to limit our overall international competitiveness. The upside for us, though, is that we have high stocks of natural resources, such as iron ore, which are in high demand for countries like China. So usually our international competitiveness is weak because we just struggle to compete because of our high cost of production. And therefore, outside of primary production or primary resources or services such as education and healthcare, we really struggle to compete. And so that's been Unit 3, Area Study 3. Hopefully this is helpful. I'll try and do budgetary, monetary, and aggregate supply policy as soon as I can. But otherwise, good luck with your studying, and I'll see you next time. Bye.